Dear student, in last lecture I told you about income statement have two part. One is trading count, second is profit and loss count. In profit and loss count, we find out the net profit and net loss of a business during an accounting period. And accounting period is that period, you know, is the ending. At the ending of the period, every accountant prepared account of in terms of profit and loss count, trading count, and balance sheet. So he want to know the net profit and net loss. To know this, he goes to prepare profit and loss count, and to know the gross profit, gross loss, he prepare trading count. So in profit and loss count, he include all indirect expenses and indirect incomes. So here he focus upon expenses. These are promotional expenses, office expenses, and miscellaneous expenses, or you can say marketing expenses. He include these expenses in debit side. So expenses he will write down in debit side. Again, income he take in credit side. So increase, if income increase, if credit is more than debit side, then it will take as net profit. If the debit side is more than credit side, then it will take as net loss. So in trading count, we use direct expenses. In profit and loss account, we include indirect expenses as well as indirect income. Dear student, you have prepared trading count and profit and loss count. So these two accounts have same format. One side is debit, second is credit. So here you can see the distinctions between these two accounts. What are the distinctions or differentiation between these accounts? Between trading count, profit and loss count. First of all, you can see here trading count show the gross profit or gross loss for an accounting year, and profit and loss count show net profit or net loss. The main differentiation between these two you can note down in second point, that is all direct expenses of business are shown in debit side of the account, and all indirect expenses, direct expenses are who are those expenses which are helpful in creation of material, and you can say uh, carriage in ward, wages, factory rent, these come. And indirect expenses are advertisement expenses, salary promotion expenses, miscellaneous expenses. These are indirect expenses. So direct revenues are shown on credit side, and indirect revenues are shown on credit side. Indirect revenue is credit side, and direct revenue item also is. So there is differentiation between direct expenses and indirect expenses. So in profit and loss count, we include indirect expenses, but in trading count, we include direct expenses. So here in balance sheet, gross profit and loss is transferred to profit and loss account, and in balance of this account is also transferred to capital account of the proprietor. So in balance sheet, there is a differentiation you can see in between these two. In final account, after preparation of trading count and profit and loss count, businessmen prepare balance sheet. Balance sheet, balance sheet is known as the balance sheet is prepared to find out the financial position of a business on a particular date. So businessmen want to know the financial position of business. That's why after profit and loss count, he prepare balance sheet. In balance sheet, in debit side, he show liabilities, and in credit side, he shows his assets. In debit side, he shows liabilities as internal liabilities and external liabilities. Internal liabilities are those liabilities, means means amount payable by the business to its owner, and external liabilities are amount payable by the business when to by the business to outsider. That means payable amount he will show in liability side, and further in asset sides he saw in asset side he saw here you can see internal liabilities as well as external liabilities. Internal liabilities are those business have to pay to its owner. These are capital, profit of business, reserve of businesses, and external liabilities are those are business have to pay to outsider. In credit side, he shows assets, assets, assets. These are as current assets as well as fixed assets. In current assets, he shows cash in hand, cash at bank, stock goods, debtors, and in fixed assets, these are land and buildings, plant, machineries, furniture, motor vehicle, etc. So after this, next one, you can see the performa of balance sheet. Balance sheets performa, you can say he shows he prepare balance sheets of particular company as own, because balance sheet is prepared on particular date. That shows the financial position of a business. And business may be travel agency, hotel, restaurant, airline, any kind of tourism business. So here one side is liabilities and another is assets. In assets, current asset he shows first current assets, and then later these are the fixed assets. Again in liability side he shows first internal liabilities as well as external liabilities. So then after at the end of particular date he prepare balance sheets.